Hello my fellow freedom builders and welcome back to the channel. This is Hans Nielsen and today we are gonna take a look at some of the stocks I am considering buying some of now when the market has settled a little down. Well, you might think that I'm kind of crazy because who would want to buy stocks in a market that goes like this? This is without a doubt the steepest turn down in the market. It is the steepest drop that I think is ever seen before. I had my video the other day how the bear market in 2008 and in 2000 and 1987 and so on, they have been showing us some sort of top formation before just dropping. And right now we are down in S&P 500 something like 30% in just 4 or 5 weeks. On Friday, President Trump, he had a speech to the press where he said that now there was a plan, or I think it was Thursday he had the speech, and then there was a press conference in the White House Friday, and the market went up on that note, and then it started to turn down again pretty quickly because it was like people were hoping for this grand plan and it was not really showing. And my guess to my customers when we were looking at the market Friday night was that Monday would take the entire increase from Friday out. And that is what happened. Today we just started with a bump up and right now it has been taken out from the prices from yesterday and we are seeing a further downwards movement. Let's see where this will take us. I could easily see something like 10 or 15% further downward movement, and that is due to the fact that the testing is only just kind of getting on track in the United States, and there has not been any real shutdown of the country like we see in most of Europe. For instance, the reason why I haven't been quite as active with videos as I had planned in these days is that the entire school system here in Denmark has been shut down. So I have my kids at home, which is a bit noisy. So right now they are out playing and I can make a video. So good for me. But you might think that I am crazy saying that the market can still take 10 or 15% down. And then I start talking about buying stocks. It is not that I am just ready to push the buy button, but if you are in a better, longer time frame in your investment horizon and you want to find some really good candidates, then now is the time to look for them. I am, as you might remember, a trend follower, so I want to see some sort of trend upwards or at least some sort of bottom formation before I just consider going in, but that doesn't mean I shouldn't plan. For instance, also in my day trading, I'm trading Forex and commodities these days on day trading. I'm doing a lot of my planning I'm doing in the weekend where the markets are closed because then I'm ready for when the opportunities arise. And they will in the market. The market will survive. It'll be a tough period and a ton of businesses will go under. I have no doubt about that. But we as human species and as a world will survive, and also the business life and the stock market will survive. Some countries have been shutting down short trading in single stocks. I kind of understand why, but that's an entirely other discussion. I have a feeling that we might, if the drop really keeps going 10, 15, 20%, we might see countries that actually shut down the stock market. And I know you might be a bit surprised that that can even happen, but that can happen and it will happen if we see some massive drops and people are, or the stock market is simply collapsing and there's no buyers whatsoever. Then we might see single countries simply suspending the entire trading sessions. So that is it. Let's have a look at some of a bit more fun part here, that is looking for good candidates. What I'm doing here, and that is a bit different than what I normally do when I'm looking for candidates, because I am often looking at graphs and I'm scanning with different instruments I have to scan the market with. But today I'm actually starting with the Fastgraph platform, because the Fastgraph shows me, and you know that if you have seen my other videos, it can show me how a company's stock price is positioned compared to its development in earnings over time. And here I have made a little screener. I'm subscribing to the large version of Fastgraphs, so that makes me I have access to the screener, and I'm looking for BBB plus rated and above in the S&P credit rating, meaning that I have sorted out the companies that is completely garbage. And I know some would even choose only one of the others here. The next one is BBB or BBB plus, A minus or A or something like that. But I have chosen the BBB plus and above. And I am looking at only United States stocks right now. I'm looking at companies with earnings per share yield of 7% and above, because that makes me primarily get companies and shares where the price right now is way below the price development. I'll show you that in a second. I've also chosen some criteria here. I want some earnings per share growth of at least 5% per year over the last 5 years. I want some growth in free cash flow. I really love that one. I want kind of normal price settings between 8 and 20 in price earning, but you can that is different from investor to investor what they prefer. On the estimates, I put a couple of total annualized return here and of 10% and estimated earnings per share growth of 7%. And when I run that screen, I come out with, on the US market, 19 different candidates here. You can either pause the screen here looking at what the candidates are, or I'll also write all the candidates in the text below the video so you can see what kind of candidates. And this is not that you can be sure that these companies are going up, but they are solid companies. They have been showing growth, really solid growth for at least 5 years. They are fairly priced right now, and the estimates are positive for further rise in earnings. However, what we should consider in this strange situation that pretty much none of us have been in before is that the estimates can be somewhat off, meaning that there will be companies here where the estimates we have are made from, maybe they're made in December or in the beginning of January, and a lot has happened in the last 2 months, and it might be so that the world have changed in a way where we are sitting with a company in a sector that is completely devastated, is completely destroyed by this crisis we are seeing right now, both because of the oil price drop, which is not mentioned too much these days, but also from this illness coming out of China. If you are wondering why I'm just talking about an illness and not saying the real name, then it is actually because YouTube is restricting the videos, and they are now, I don't have advertising on my channel yet, but they are removing ads from the videos where this illness is mentioned by name for some reason. So it is just called in my videos the illness out of China. I have seen someone call it the beer virus or the butt visor virus or whatever, but I think you know what I mean here. All right, let's have a look at some of these stocks here. And as I said, I will write them below the video, so you don't have to write them down here or take screenshots or whatever. I will not do as much of an in-depth analysis as I usually do in my stock of the week videos, because that is not really what this is about. This is more a screening, so I have a list of candidates that I can take a daily look at and seeing, are they showing some sort of movement upwards that suggests that the downwards movement is over. So let's have a look here. The first one is we have ABC, we have AMERISOURCEBERGEN here, and they have some very good numbers. Let's just have a look at it on the graph here in Fastgraph. Just a second. Here it comes. And here, let's just see. Yeah. here we have for a lot of years. Let's just take for the last 12 years here. That is 10 years of history and a couple of years out in the estimates. Here we have a company that has actually been dropping in price since 15 or so. So had you bought it up here, you could of course have bought it down here and still made money. But as you can see, the historic growth rate here is just around 12.5%. And we have the growth rate here. We also have the PE ratio of 15.5. And the price is oscillating somewhere around that. But if you had bought it up here somewhere where it was actually overvalued, where the price had gone up way faster than the price, than the earnings development, then you could have gotten in here, for instance, taking a bit of profit here, or it gone up a bit, and then still after 5 years or something like that, even with the dividends, you would be down minus 0.6% per year. So there's not much reason in buying stocks that is way above their earnings development line. Of course, sometimes you will see stocks that keeps going up for 5 years, but it is more normal that we see it returns down to the average. So right now we have AMERISOURCEBERGEN, which is a very solid growing company that is way below its own earnings lines here. You can see that is adjusted earnings. We can also look at owner's earnings or free cash flow or EBITDA per share and so on. There are a number of ways here. But this is just the first glance. This is actually in the zone where I would like to start looking at it. And of course we could look at the price here and just look AMERISOURCEBERGEN up here. And it doesn't look terrible. We can have a comparison here to the S&P 500, SPY here. And you can see on this graph here, the gray line here is how AMERISOURCEBERGEN is doing compared to the overall market, and it is simply crushing it. Even though it hasn't performed very well, then the market has been absolutely destroyed. So you can see from a top here in February and then until today, we are seeing a drop in price of something like 12-13%, which is actually something most investors would be quite satisfied with, I think. So right now we are in a very long sideways movement here, and if we should be looking for something that could go up in the future, this might be one of them. We could also have a look at the Stockopedia. We have a good earnings quality. The value is 51, that is okay. The momentum is 96, and that is both in earnings but also in estimates and in numbers coming out and in analysts saying that they are adjusting the analysis and the estimates upwards. So that is 96 is very good. Overall stock rating of 95. So here we have a good solid stock. PEG ratio of 1.2. And as I said, this is not the in-depth analysis. This is just running over the numbers, seeing could this be a candidate that I would have a look at and have on my list to look at once a week or a couple of times per week. So if you have a PEG ratio of 1.2, I like that to be below 2. That is our earnings per share divided by the estimated growth in earnings. So this could easily be wrong if the earnings are way off, but as you know, some sectors are doing better in times of crisis. And if you didn't know the AMERISOURCEBERGEN Corporation here, I think many of you do because it's a large company, then we can just go down and see, well, it is a pharmaceutical sourcing and distributing service company. The company segment includes pharmaceutical distribution and other, provides services to healthcare providers and pharmaceutical and biotech manufacturers. All right, so this is in the pharma industry. Do we think that medicine, that drugs, that all of these pharmaceutical companies, will they be hit severely by a crisis? Well, they might, but there is in the history a tendency that these sort of companies are doing quite well, even though the entire market crashes, because people still need their medicine. So I think this sector is pretty safe, even though we might see some further downturn in the market. We can see what we also saw at Fastgraphs, that the earnings per share is going up nicely. We can see the operating margins are not extremely high, but that is a thing we could investigate a bit further. What I do like is that the free cash flow, at least here from 18 to 19, went quite a lot up. And let's just see here, my screen is a bit compressed here. Let's have a look here. Yeah, we don't have any estimates here, but we can see that the dividend is around 2%. The dividend cover is fair right now, about 3 and 2, and it's going quite a lot up if the estimates are holding, if they're true. So that is fair enough. Working capital is not amazing, but they are, the net debt is going down. So we can have a look at all of these numbers, but I will do that on a later time if AMERISOURCEBERGEN is something that I say now is the time to buy. Right now, a company like this will most definitely come on my, be put on my candidate list. All right, let's have a look at another one. We can just take the next on the list. That's AUTOLIV here. And let's see it in the Fastgraph. All right, here it is. And you can see that pretty much anywhere you would have bought it, where it was in the expensive zone up here above its earnings and earnings per share growth line here, had you bought it even here at the low point in 14, you would here 5 or 6 years later be down 2.4% per year, even with the dividends added. So it has been growing its dividends, that's fair enough. The earnings growth has been a bit chubby, and it actually dropped, which normally would make me disqualify this candidate here. I don't like these drops in earnings, but it is something that I could investigate further, because there might be some reason for that I could live with. The earnings growth rate is not amazing, but you can see here it has taken a huge drop. And from here, let's just say that there was not any given reason for this, because you should remember that just because a company is down here and seems cheap, it might be cheap for a reason. It might be what is called a value trap, meaning that we look at it and we love the dividends and we love the price it has dropped to, but something has happened. Something has disrupted the business model, maybe. So that is something we should investigate further. But if not, and if it just were to go up and hit this line somewhere between the next 2 and 3 years, then there would be some quite crazy earnings per year on the AUTOLIV here. And let's just have a look at it in the, we can just have a look first here. AUTOLIV. And of course, this is not a development we really like. And as you can see, a stock goes into red zone when it drops, when the RSI drops below the 50 line, and it is doing worse than the market. So we would actually have gotten a sell signal up here around a price of 80, 79, 80 here. And I would have dropped this one. I've done that with all my other stocks when they started to drop into red zone, and that would have spared me for something like a 40% drop in this. So of course, as you know, I never get in exactly on the bottom here, so it will go up somewhat before I really start to fancy it here. So it might be up at, I don't know, 60 before I start buying it, but that still means that I missed this entire drop, and I was weeding out a lot of really bad volatility in my portfolio. But I've talked about that in other videos, and I will take that up later on as well. But right now we're looking at stocks, and right now this is what you would call a dropping knife. You might have heard the term that you shouldn't try and catch a falling knife. This is right now a falling knife, and a value investor, a pure value investor, might be saying to him or herself, now it is cheap. But there is just a tendency, and I have seen it way too many times, that cheap can get cheaper. So I do like to see some beginning of a solid uptrend on the weekly chart before I buy it. But let's have a look down here, or in here, at AUTOLIV here. Let's just see. Here it comes. Yeah, and 82 in quality, 63 in value. That's okay. Momentum is not huge here, but the stock rank overall is 83. So that allows us to move on with the analysis. 0.4 in PEG ratio seems okay. Dividend yield 5.3%. Great. We have a price to book at 2, EV to EBITDA at 5.4. Okay, there's nothing here that really disqualifies it. Petrosky scored 6, that's fair enough. An okay growth in earnings per share. It had a drop there in 18. And let's just see down here, the cash flow also had a drop, as did the free cash flow. But it seems like they're building up again, and we will investigate the company further. Nothing here that completely devastates the picture of the company. Dividend is growing a bit here and is now at 5.2, 5.3%, and with a decent dividend cover. Okay. Net debt, so they actually have a positive here on the net debt, meaning that they have money on the book here. Working capital has been dropping, and what can we see? The interest coverage is okay. So numbers here are fair. We can see that the analysis consensus is hold to buy, and we can see that AUTOLIV is a supplier of automotive safety systems. I guess you knew that already, with a range of product offerings including passive safety system and active safety system, so on. This is products for the car. And here is an example where you could sit and think for yourself, that would people buy stuff like this in a time where they are not sure if they're getting laid off, if they're getting fired, if there'll be money enough? Are they living somewhere? It could be in the United States, where they're not sure if, for instance, if they get sick now with this illness spreading really quickly. As far as I can tell, you can get tested for free in the United States, but I'm not sure you can get treated for free. I might be wrong here. I haven't dived a lot into that. But as far as I could tell, it was only the test here in the first round that was for free. And the treatment for the illness would not be free. But let's say that was the case. Then you might think that companies like this, products like this, they might not go out, buy a new car, buy a new safety system for the cars and so on, in a time where they might not be sure that they'll have money enough for the next time period. The same is with jewelry, with televisions, with all sorts of stuff that might be a bit of a luxury item. So this is one of the companies that I might dive a bit into and see how much is that actually affected by the entire development in the world, both as to the oil price drop and the spread of the illness. All right, let's just have one more just to give you an overall idea here. We have AMAT, Applied Materials, also a very solid company. Here we go. And you can see that they also had a drop in earnings. But the estimates are showing that that should be corrected now, and the price was just up in the beginning of the expensive zone here, you could say, but it has dropped down, and if this is something you want to pursue, then wait for some sort of bottom formation. We could see it down here. Now I could zoom in on my normal chart and have a look at that, but in here I might have been interested in Applied Material here, because it was cheap compared to price, and it started to make a bottom formation. So I might have taken it up and at some point have been up making 46% per year, but of course also taking some sort of drop in price here. We can just have a look at it in the chart. Let's just look at AMAT here. All right. Now, this is an example. I might have gotten out actually only last week or so. in this, because this is an example of such a quick drop in price. As I said in the beginning, in 2000, 2001, in the crisis in 07 to 09, there was top formation telling technical analysis like me that now you should be careful. Now it is starting to look very negatively in the market. So I got out of the of stocks way before the large drops in markets. I must say I've also gotten out pretty quickly in this drop, but I have been a bit more hurt on my stock portfolio than I normally do in these crashes. I was up something like 12 or 13% when it was best this year. That was in the beginning of February, mid-February. And then everything took a huge cut down, as you know. And it got so quickly and so bad that my entire profit for the year disappeared. And I think I am actually down something like 4 or 5%, something like that overall for the year. But I think a lot of investors would be satisfied with just being 5% in minus for the year here. So this is one of the stocks where I would simply have gotten surprised by the movement, and my models wouldn't have said sell until I was fairly low down here. But that is of course always something. It's always easy to be to look in the rearview mirror and be such a clever dude there. So the Applied Material here, absolutely a stock I would have a look at and put on my list of candidates. We can just have a look in here, just as the last candidate here, Applied Material. And let's see, looking good. The value indicator here is not extremely high, but it doesn't have to be so. Let's just have a look down here. Earnings per share, okay. Dividend cover, fair enough. Yeah, well, things look fairly well here. And again, it is someone that could be put on my candidate list. And of course, there could be criteria that disqualifies it when I dive deeper into it. But I must say that all of the candidates that turn up here, when I look at the Fastgraph screener, that is rock solid companies. And we could always be down here and guessing Applied Material here. That is a semiconductor company, as you might know, equipment for services and software and so on, global semiconductor, display and related industries. And it could be a case by case for these companies, because some of the software and IT based companies will have a huge advantage in the coming times here. For instance, I have a feeling that Microsoft will be a good candidate because they have this big platform that makes it easier to work from home. And if we're going to see 3 or 5 or 12 months where a lot of people work from home all over the world, that might be a big boost. Without going too much into depth, I could see that some online gaming companies, and now I'm just zooming a bit out and not looking at the fast graphs, but telling you some of the considerations I'm making for myself here. It could be companies like let's just say EA Games, Electronic Arts, that has a lot of gaming and online gaming platforms. That could be a company where we are saying, well, if 1 million or 10 million kids all over the world all of a sudden is stuck at home, their parents have to work from home, so they have to keep these kids quiet for a while they're working. Well, then gaming, online streaming, you could say that a company like Netflix could be interesting. They are, however, offering some, I think they have a month of free trial, so that would at least be something that new customers would test out first. I would also look into consumer staples. I would look into companies like Coca-Cola, companies producing basic food, and that could also be companies making everything from toilet paper to disinfection products. It could be Clorox, it could be, there are a lot of companies, and I will in the upcoming time here, where there are not many specific companies that really interested, me, or they do interest me on a fundamental part, but they are not really interesting for me yet on a technical part. Then I will make more videos about what sort of sectors. I'll dive into some different sectors and have a look at them and see what kind of companies I'm looking at here. But this is to give you some sort of idea that what I do first is that I try, when I screen, to see if there are some candidates I didn't find in my first looking around. Then I do use Fastgraphs here. I do use Stockopedia, and then of course for the graphs I use TradingView. I'll link to all of them below, as well as the companies I have come up with here on my list. So I hope that kind of gives you some sort of inspiration and idea of how I'm working. And just to have a quick glance here at the graphs for today, let's just make it as up to date as possible. We have the SPY here, which is actually going a bit up again here. It started here, went down, now it's up again. So let's see where it ends. Even though we might see some rises here, I mentioned that in my video the other day as well. Just remember, if we just hurry back to 2008 here, we saw these big drops, but then again, once in a while we had a string of weeks here where the market actually went up 10-15%, and again here we had gone up 10%. Again down here there was some weeks where we went up 25%, and people were very eager to tell us in the press that now we'd seen the bottom. Well, fair enough, but if you had bought in here believing that was the bottom, then you would have taken something like 30% more off from the time you bought here. But again, this was one of the largest financial crises in the world. And even if you have bought at the exact top here, if you have been really, really unfortunate and buying just here, of course you would have been down with almost 60%. But this was in October 07, and in the absolute worst case, you would be in break-even a number of years later. And of course, you might have bought on the way down here, so you had a lower average price. So just remember, this was the worst financial crisis so far, at least. And still, if you had a long time span, a long time horizon for your investment, you were not completely bankrupted afterwards. So things really started to pick up. But of course, that is at least my philosophy. There's not much reason in buying in a market that is dropping still 30, 40, 50% if you can time it a bit more down here in the bottom. So that is my view on it, and I know a lot of you are of the have the philosophy that you should never try and time the market, and that is also okay. I know of several investors that are doing very fine not trying to time the market. So that is a bit up to you. I hope that was enough for today, and if you haven't done already, remember to subscribe, like the video and all that down there, and I'm looking forward to posting some more videos here in the next week when I have sent my kids out in the garden to play. That's all for now. Take care of your money out there. Bye for now.